Good evening, everyone. Welcome to our Let's Trade Live weekly webinar. This is Wayne, Head of Research and Education. On behalf of Fullerton Markets, I warmly welcome everyone. So as you can see, the date is 13 February. So I'll just take this chance to wish everyone in advance a happy Valentine's Day. Yes. So let's jump straight to the webinar for tonight. As usual, we will cover the events that has happened for the past 1 week. Then we will move on to look at the calendar to see whether there's any data to watch out for, data or news. And finally, we will move on to the charts. I'll take the request that comes along to see what symbols and what instruments that you want me to look at and the time frame. Of course, as usual, feel free to type in your questions. I'll answer them along the way. Okay, let's look at last week's event. The first one, of course, Mario Draghi spoke last week. So, of course, he rebuts Trump accusation of currency manipulation by ECB, and also Germany taking advantage of the grossly undervalued euro, as you can see from the first paragraph. So of course, Mario Draghi won't sit back and just watch all the accusations. So what he did is he actually rebutted, and this is what he said. As you can see, is highlighted the two paragraphs. ECB has not intervened in the foreign exchange market since 2011. And he also highlighted that Germany has a significant bilateral trade surplus with US and current account surplus. And it has not engaged in persistent one-sided intervention of the foreign exchange market. So basically, Mario Draghi is saying Trump's so-called accusation is not true. And of course, there's a counter-attack from Mario Draghi. It says that this is pertaining to the Dodd-Frank Act that President Trump is trying to review or even remove. So as you can see, the last paragraph that is highlighted, the last thing we need at this point in time is a relaxation in regulation. So Mario Draghi mentioned that he doesn't see any reason to relax the present regulatory stance, which has produced a stronger banking and finance services industry. So that was the counter-attack from Mario Draghi. Interesting. So you can see there could be some ongoing verbal exchange between US and ECB. So it'll be interesting to watch out for. Of course, how would all this verbal so-called exchange affects the market? I think it is more for dramatic purpose. For us as a trader, we will just watch from the sideline. But what is interesting to take note is from Mario Draghi's speech is that he still highlight that the current situation doesn't warrant a tightening or the reduction in their stimulus. So meaning to say, stimulus will still be proceed as planned until end of the year. So of course, among all the verbal exchange, this is the most important in our view to help us make better trading decision. So for now, it is expected ECB is likely to maintain a loose monetary policy. As I have or we have mentioned earlier this year, we do expect them to maintain a loose monetary policy up until at least after the first half of the year. And the key reason, of course, is the uncertainties that is coming out from not only from US, from Donald Trump's policies, and also uncertainties from Europe itself, within Europe. As we know, there are a lot of political uncertainties upcoming in the next few months. We have the French election, and later, after the first half of the year, there will be a German election. And not to mention the ongoing Brexit saga. So there are a lot of uncertainties for this year especially. So it is expected that ECB would maintain a loose monetary policy to counter all the uncertainties, at least until after the first half of this year. So the next event, of course, is Reserve Bank of Australia. They maintain their interest rate as expected. So the interesting thing to take note from Australia's side, they are pretty optimistic of the outlook. So based on the global growth and recovery, they are quite optimistic. And as you can see, the highlighted sentence over there, usually why we highlight is because it's something to take note of. It's hard to say that the exchange rate is fundamentally too high. Because traditionally, or rather in the last few years, it is always common for RBA to mention that the Aussie is too strong, because in the last few years they are still in the midst of recovery, so they need a weak currency to boost their exports. That's number one, and also to prop up their inflation. So they need a weak currency. So with the recent so-called improvement globally and also domestically in Australia, they are mentioning this, they are switching slightly. They are saying that the exchange rate is fundamentally, it is hard to say that the exchange rate is too high. So they are finding it a challenge or difficult to justify or to mention, oh, the Aussie is too high, doesn't reflect the correct rate. So having said that, it means that if Aussie continue to strengthen slightly further, it is still okay. So that means that's why after their statement, you will notice that the Aussie actually strengthened. So at this moment, we don't foresee a potential rate cut in the upcoming months from RBA. They are expected to maintain their interest rate and their optimism. So of course, the Aussie may weaken against the US dollar depending on the strength of the US dollar. But Aussie on a whole in general, based on the current situation, it is expected to be strong, especially against the other non-US dollar currency. So the next central bank that have announced their interest rate is Reserve Bank of New Zealand, Australia's closest neighbor. So of course, they also mentioned that their economy is also growing recovering quite well. Their annual growth is about slightly more than 3% per year. So that's the reason why market was speculating possible tightening prior to the central bank making their statement. So they are expecting RBNZ to drop some hints, maybe to look at possible tightening, because they are facing some pressure from prices rising, and also economy is growing at a healthy rate. But instead, the New Zealand Central Bank mentioned that it plans to maintain the borrowing cost at record low, so it dampens the expectation of rate hike. That's number one. And also very interestingly, they also mentioned that they're going to maintain a neutral policy as of now. So it also dampened any possibility of a rate cut. So it is expected for RBNZ to maintain their interest rate in the near future. So if you look at what they have said at first and after that second, we would expect the market to remain neutral to the Kiwi, neither buying or selling. But what the market latched on is what RBNZ mentioned, that the currency remains higher than it's sustainable for balanced growth. As you can see in the last paragraph, let me repeat the last paragraph. If you can see the words, if you can't, I'll read it out. The currency remains higher than is sustainable for balanced growth, meaning to say it is as good as telling that the Kiwi is too strong for a sustainable balanced growth, implying that the RBNZ wants the Kiwi to weaken. So even though at the front, RBNZ mentioned that they will maintain a neutral policy, but at the back is what the market decided to focus on. Oh, the RBNZ wants a weaker Kiwi. So that's why we see a very significant sell-off in the Kiwi after the statement. And if you look at the contrast between RBA earlier, who mentioned that they don't find any reasons to justify the Aussie is too strong, meaning it is okay for Aussie to remain strong, versus Kiwi side, who mentioned that Kiwi is too strong at the moment. So you'll notice a difference in two neighbors' so-called view towards their own currencies. And that's the reason why you see Aussie Kiwi heading for a very strong uptrend. So later, if you are interested, you can type in the request to look at Aussie Kiwi. We can open up the chart and look for any trading opportunities. So that's RBA and RBNZ. Next, of course, we have seen the dollar strengthen. And the key reason, of course, is Trump promises for phenomenal tax plan in the upcoming 2-3 weeks. So this is a classic example that market is trading based on expectation even before any tax plans is being released. So all Donald Trump needs to do is to mention, oh, I'm going to release a phenomenal tax plan in 2 to 3 weeks time. And the market buy the story, and we see the dollar strengthening. So since Donald Trump sworn in as a president, we have noticed his policies and his comments are actually swinging the dollar a lot, much more than the data. So this is something that we as traders would have to watch out for. So in the upcoming weeks and months, we can expect the same to continue, meaning President Trump, whatever policies he released, whatever comments he made, will definitely have a impact on the dollar. And the interesting thing is, whatever policies he's made is pro-dollar. That means it's positive for dollar. For example, all the war that is building, that is going to increase the spending, make more jobs, etc. And the tax cut is supposed to improve business. So business will enjoy the tax cut. It's good for the economy. More business will stay in US or even go to US. So all these are good for the US economy. It is boosting the strength of US dollar. But his comments always mention that, oh, the other nations should not manipulate their currencies or artificially weaken their currency so that they enjoy trade benefits against the US dollar. Because other nations, if their countries' currencies is weak, they can sell to US. It's easier to export to US. But for US to export to the other country, because US dollar is strong, it is harder for US to export to other country. So Donald Trump wants to focus more on exports, because only exports they are able to so-called earn revenue from their exports. So Donald Trump wants a weak dollar in order for them to improve their exports, but instead of being too direct saying that he wants the dollar to weaken, he is so-called calling other nations as currency manipulators, trying to weaken their currency so that they have a trade advantage over US. But for experienced traders or analysts, they will read between the lines and know that Donald Trump wants a weak dollar. So you will see the dilemma. On one hand, his policies are improving the current economies of US, thereby boosting the strength of dollar. On the other hand, he wants the dollar to be weak in order to improve exports. So it's not surprising to see the dollar swinging up and down from his comments and policies. So it will likely to continue at least for the next few months. And of course, later we'll go on to this week's calendar. Fed Chair Janet Yellen is scheduled to speak. Later we'll talk a bit on that. So there's so much for the key events and news that we should watch out for or take notice of last week. So let's move on to the calendar for this week. So this is Tuesday, Valentine's Day. Yes. The news that we have picked is actually UK news, CPI, Consumer Price Index, 5:30 p.m. GMT plus 8. I have received some email asking me to clarify, what is this GMT plus 8? GMT plus 8 is a time zone. It's basically to say this time belongs to which time zone. So GMT is basically a Greenwich Median Time, which is somewhere in Europe. So from there onwards, GMT plus 8 means 8 hours ahead of GMT. If it's GMT minus 5, that means it's 5 hours behind GMT. So GMT plus 8, basically some of the countries that fall under this time zone is basically China, Malaysia, Singapore. So it is the GMT plus 8 time zone. So let's move on. So the news is 5:30 GMT plus 8 time, afternoon. So the market expectation is 1.9% in terms of CPI. So our suggestion is to put a pending long pound dollar if the actual number comes in higher than that. So higher than that means it's 2%. 2% or more. So this is a pending long pound dollar. If the actual data is as expected, 1.9% or even lower, then it doesn't fulfill the criteria to keep a pending order. So this is our suggestion. If the CPI can really hit 2% or higher, then there's a real good chance to speculate, or the market may start to speculate tightening from BOE, Bank of England. Then the other thing to watch out for, of course it's not a data but something to take note of, is Fed Chair Janet Yellen is scheduled to speak. So this is her first semi-annual monetary policy report since under the new leadership of President Trump. So this is her first semi-annual report on monetary policy. It's divided into two parts. So Tuesday there's one, which is for Tuesday it's basically a scripted statement. She'll just announce it. But on Wednesday you will see that there's more of like a Q&A, press conference kind of thing. So it's unscripted. So on Wednesday night as well, 11 p.m. and Tuesday night, 11 p.m. Do watch out for, there may be some volatility in the dollar. So in case you are holding any dollar positions. So when I say dollar positions, means any currency pair that has US dollar as one of the currency. Example, Euro USD or USD JPY. These currency pairs. So for Wednesday, suggestion over here again is also UK news, 5:30 p.m. So this is employment data, which is a claimant count change. So claimant means the number of people claiming unemployment benefits. So if it's a positive number it is considered not a good data. Positive number means there's an increase in number claiming unemployment benefits. So take note of, for claimant count change, the higher the number, the worse it is for the sterling. So our suggestion for this data is a pending long pound dollar, expecting good data or anticipating good data. The market is expecting bad data. As you can see, it's a positive 1K. Not very bad, but it's still considered bad because it's a positive number. So our suggestion is, if the actual number is smaller than minus 5K, meaning instead of the number of people claiming unemployment benefits going up by 1K, it has reduced by 5,000 people or more. So that's why the suggestion is a pending long sterling dollar if actual is less than minus 5K. So if the number is above minus 5K, meaning it is minus 4.5, minus 3, minus 1K, then it doesn't fulfill the criteria for this pending order. So this is our suggestion for claimant count change. Of course, later on Wednesday night, 9:30 p.m., there will be the CPI of US. Okay, core CPI. As you can see, there are two CPI. The one on top that says Consumer Price Index, that is including food and energy. The one that we want to look out for is basically the one without food and energy. It is called the core CPI. So it's a consumer price index excluding the prices of food and energy. Energy means oil prices, gas prices. The reason why these two items is being excluded for the core CPI because of the volatility in prices, and they could swing the CPI heavily. So sometimes trader will prefer to look at the core CPI, which is looking at the price increase of other goods and services, excluding food and energy. So the market is expecting 2.1%. So our suggestion is a pending long euro dollar, expecting bad result, of course. So that's why it's a pending long euro dollar. If the CPI is lower than 2%, market is expecting 2.1. So if the actual data comes in lower than 2%, meaning it comes in at 1.9% or lower, then it fulfills our criteria for this pending long euro dollar. So if the CPI did not meet expectation and came in way off expectation, we could expect some weakening of the dollar, because market may start to scale back on rate hike. They may delay the expectation of rate hike to after first half or even after third quarter of this year. So if that's the case, then we could expect some weakening in the US dollar. And of course, again, just to highlight at the bottom, as you can see, is 11 p.m. GMT plus 8. That is the time where Fed Chair Janet Yellen is scheduled to speak and answer questions to whatever statement or speech she has made the previous day. So because this is unscripted, so they definitely will have some interesting output and may cause some serious volatility in the dollar. So again, if you have any open dollar position during that time, do watch out and manage your risks accordingly. So we move on to Thursday for this week, and that will be the suggestion for Thursday would be Aussie employment change data. So this is employment data for Australia. So Australia economy has been growing well. So this is the suggestion. Market is expecting 10,000 jobs added. So our suggestion is pending long Aussie dollar, expecting the actual number to be greater than 15,000, way above what the market expected and even higher than the previous month. So if that's the case, we do expect maybe the Aussie to continue its strength in the short term. So this is our suggestion. If the actual data falls short of our criteria, meaning it came in at 15K or lower, then it doesn't fulfill our criteria for this pending order. So that's so much for the news that we suggested for this week. And again, this is our accelerator, a gentle reminder for everyone, our most popular promotion so to date. So if you have not checked us out, do so. It's fullertonmarkets.com/promotions. Get up to USD 10,000 for free. Of course, terms and conditions apply. Next, we move on to the last segment. We go on to the charts to look for any trading opportunities. And this is the time I'll open the request to the floor. Type in any currency pairs, any instruments, any time frame that you want me to look at, and we will go through one by one. Of course, I will apologize in advance. Due to time constraint, I may not be able to handle all the requests. But do keep them coming in, and I will do my best. So while we are keying in the request, I'll just quickly run through what are the charts that we have looked at last week. Very quickly, this is dollar yen H1 chart, which was requested last week. So I marked the support. The vertical line is basically the time of the webinar. Okay, at the time of the webinar is where the vertical line is. So I marked 112.20. Of course, at that point in time, I mentioned I do not expect the dollar yen to break and go further down. But whatever I expect or not expect is one thing. For those of you who know me well enough as a trader, we react to the market. So what I did is I gave two suggestions. One is if the price hit 112.20 and bounce up. And when it bounced up, I want the candle to close in the upper blue box over here before I decide to go long. So that didn't happen. It's basically just a tail that went into the blue box. It doesn't close in the blue box or beyond. So it doesn't fulfill the criteria for me to go long. And the other criteria is basically if the candle close at the lower blue box. So when it closes at the blue box or lower, that's where after it closes, we can go in for a short. So if some of you have caught this, this is not a very big move for H1 chart. The full move is about 40, slightly above 40 pips. So if you can grab about 30 pips out from this move, is considered pretty good. That's the first suggestion. And the other suggestion is if the price shoot all the way down to close, do not enter first, wait for the price to retrace back up, come back down, then that would be the second chance for you to go short. So that didn't quite fulfill the criteria. As you can see, the price did short all the way down, but it hovered there for a long time. So it sort of break this kind of pattern whereby it shoot down, and in a short while, within the next few candle, it should retrace back up. In the next few candle, retrace back down. So of course, some of you may be confused when I say next few candle. So how many is next few candle? So for the benefit of you who wants, for those of you needs a more objective definition of a few candle, it would be something between 4 to 5 candles. because anything beyond 5 candles means that the market has been doing something else already. So that's dollar yen chart. So if some of you have caught this, would have made about 30 pips or so. If not, you may not have caught this trade, which is fine. The next chart that we have looked at is basically the Euro Sterling. Again, the vertical line defines the time of the webinar. So there are again 2 suggestions. One is for the price to hit into the support of 0.8580 and bounce up. So that didn't quite happen also. Did not really went. There's no shadow going beyond it. No candlestick touching around the area as well. And if there is such a thing, then when price bounce up to the blue box over here, then I would take a long trade. So did not happen. The other suggestion is if price break the 0.8580 somewhere in the blue box below, close into the blue box or lower, then possible can consider to go short. That was our suggestion for last week. So there was a strong candle that pushed all the way down and definitely beyond the blue box. So if some of you have caught it, this is a 4-hour chart. So there's a 4-hour window for you to catch this trade. So if you enter this trade, depending if it is still floating about 60 over pips. So if you have like taken 40 or 50 pips and then shift your stop loss to your entry price, then chances is you will have taken your second position out at break even in the tail over here, but at least you bank some profits from this trade as well. So again, I hope that some of you have caught this trade, Euro Sterling. The third chart that we have looked at is basically Euro Dollar. So I highlighted the head and shoulder. Okay, there's a comment made which I typed in last week. Consider to look for bearish candlestick pattern to take a short. This comment applies to the purple window. If some of you recall, I mentioned that to look for a candlestick pattern, bearish candlestick pattern to take a short at the purple window around there about. That is one of the suggestion. The other suggestion is at the time of the webinar, the candle is moving down, actually breaking the neckline of this head and shoulder. So I did mention that the typical way of trading the head and shoulder break of neckline is after the break just go in for a short. So the other option is after the break, as you can see the bear candle over here, it closed way below the blue box. It fulfills the criteria. Possible to go in for a short. Alternative that I have given is a less aggressive way is wait for price to retrace back up above the neckline and then drops back below. Then you go in for a short. Either case, in this example, your entry price should be around the same price. Whether you go in for an earlier entry at this candle where the blue arrow is pointing upwards, that is considered a more aggressive way of entering. Straight away after the candle close below the neckline, you enter for a short. Of course, the other one is a more conservative one. You wait for prices to retrace up and see whether is it a false break or not. And as price coming down, it is confirmed it is not a, most likely not a false break, then you take the trade. So both is entering at the almost the same price in this example. The only question is the timing of entry. One is earlier, one is later, that's all. and the price has moved about 100 pips downwards in favor. So depending on where you take your profit for this trade to grab, I would say to grab 40-50 pips, it shouldn't be that difficult out of the full move of 100 pips. And for those of you who likes to hold your position and do a trailing, possibly you could still be seeing the floating profit now. So this is euro dollar that we have looked at last week. Next chart, Kiwi yen. So this the Kiwi yen I mentioned, consider to go short, trading the 3 black crow pattern. So the vertical line is the time of the webinar. 1, 2, 3, 3 black crow. There's a 3 bear candle. Short at the next candle. So of course this short, it depends on where you place your stop loss. If you place a very tight stop loss like 10 to 20 pips, then possibly you could get hit by your stop loss before the price move further down. But if you reference the last bear candle over here and place a slightly higher stop loss of 25 pips or 30 pips, then possibly your trade will not be triggered. I mean, your stop loss will not be triggered. And the full move downwards give you about, not a lot, 20-24 pips. So this is M30 chart. So for, I will describe some real scenario. So imagine after the 3 black crow at the opening of the next candle, which is around the price of 81.8485, around 81.85. You enter for a short, assuming you place a stop loss that is higher than the last high of the candle. So that will be about 25 pips of stop loss. And now the price move against you. Yes, you are staring at negative losses. You are staring at losses, floating losses. And the price move downwards. So after that, you are staring not a lot at about 20 pips or 18 pips kind of floating profit. And then market hover there for how many candles? 2, 4, 6, 8, about 10 candles, which is about 5 hours. And eventually prices move further down and then reverse back up for all the way higher. So in actual fact, when you have a live trade like this, unless you place a target, otherwise you need to do periodic, what I call periodic monitoring. So the periodic monitoring will depend on the time frame that you are trading. If you are trading a lower time frame, of course you need to monitor the market more closely, because in this example, every 30 minutes is one candlestick. Of course, if you are trading the higher time frame like the 4-hourly chart, every 4 hours is one candlestick. Your monitoring will be slightly longer. Maybe you need to monitor 3 times a day, kind of thing. But if you are trading M30 chart, chances is every hour or so you need to look at how your trade is doing. And the good news is, in case some of you are thinking, wow, like that is very tedious if you need to do such close monitoring of your trade. But that is the most common question that I get. But the best answer is, trust me, when you are trading with real money, you will monitor your trade very, very closely. Even though I tell you that you need to monitor it every few hours, you will still look at it every few minutes. That is what I call real trading. So when I say that you need to monitor this trade every hour, it is actually quite practical. And most traders actually will look at this trade every few minutes. So if you see a candle or the price really move a lot in your favor in this case, then it is my personal habit also, when I see the price move in my favor significantly, like in this case. When I say significantly, it has some discretion. Like for example, in this case, I've seen the market hovering in a sideways fashion for 5 hours, and suddenly I see the price move like that. It is considered significant because compared to the last 5 hours, it is significant. So with such significant move, if I don't have a profit target for this trade, my habit is always to protect it, make it risk-free first. I will always shift my stop loss to my entry price or close to my entry price to protect it in the event of worst case scenario. For whatever reason, price reverse all the way up, and this is the classic example. I do not lose a single cent for the trade. That is the absolute worst case scenario. So that is my personal trading habit when it comes to managing open positions. So this Kiwi Yen M30 chart. And the next chart is basically Pound Aussie. Pound Aussie, I gave a few, not a few, basically two. A few is more than two. Basically two suggestions. The first one is if the price closes into the lower box. Okay, as you can see the arrow there. So price close into the lower box or lower, that would be where I would go for short. Didn't really quite happen. Again, it's the tail that touches it. I want to see a close. That means the body going into the blue box or lower. That is the first suggestion. Of course, the next one is if the price reverse the other way, close into the upper blue box. Okay, I'm going to shift this price label because it's blocking the candlestick. So I'll just switch it over. I'll maintain the value, so it's a 1.6415. Okay, that's basically the price of around the blue box area. So I want to see a candle that close into the blue box before taking a long trade. And here, take a look at the price action over here. Yes, it may fulfill the criteria. As you can see, the little candle that closed into the blue box. Okay. So at that point in time, we do not know what is going to happen in the next few candles. Okay, I'll put a vertical line. I'm referring to this candle over here. If you go strictly by my definition, this candle has closed into the blue box, possible to take a long trade. Yes. But if you look at price action for the next 4 candles, and this is a 4-hourly chart. Next 4 candles means 16 hours. So for 16 hours, what I'm seeing is there's a price fight. Especially the candle over here. Okay, the candle over here pointed by the red arrow. Very small body, very long upper shadow. So such candlestick tell us a story, or at least tell me a story, saying that the bull fought and won in the first half. The bear fought back in the second half and won. So there's a fight between the bull and the bear. So bear won the second half. That's why it pushed the price back down. So this is a telltale sign that the price is uncertain. And if the bear has the momentum from second half and it continue to push downwards, then of course my trade would be in trouble. So typically, if we are in a position to see this, then I usually will close out the trade and look for the next one. So even if the price eventually goes up, it doesn't matter to me. I'm moving on to the next trade. So typically after these few candles, if I see such things happening with shadows going up, fail to go higher, it is a clue or a telltale sign. The market is telling me better get out. So I'll get out and don't look at it anymore and look for the next trading opportunity. So that is pound Aussie. And the last chart that I've looked at, or we looked at, is basically gold. So gold, I mentioned that I'm on a long bias. So long bias, expecting to buy at dips. So buy at dips means if the price retrace lower and bounce up, give me a lower price to enter for long. That would be where I would go long. Unfortunately, it did not happen, and price went higher. So some of you may be thinking, yeah, we missed this move. We should have entered here. So this is a bit of trading psychology. If you do that, you will find yourself doing that pretty often in the market. Because for real traders who have been trading long enough, you know that we will not be able to profit or take profit in every single move. So there will be times whereby, yes, we expected the market to go long, go up, we want to buy, but it doesn't give us an entry, or it doesn't fulfill our trading plan to go long, and the market proceed without us. So this kind of situation is quite common, because the market is moving up and down every day, every second. So this goal we have looked at that for last week, 6 charts. So without further ado, I'm going to move on to look at the current requests on my screen. The first one is which direction will pound dollar go? Bullish or bearish? Let me open the pound dollar first. Okay, I'm going to remove all the markings. Pound dollar. Since you have not mentioned the time frame, then I'll just choose a time frame to look at. And the question is interesting. Will pound dollar go up? Which direction will pound dollar go? Bullish or bearish? I do not mean to make fun of your question, but if you look at it, the answer to the question is it can go bullish and bearish, because it depends on what time frame we are looking at. The pound dollar may go up in the first minute and go down in the second minute, or it could go down in the first hour and go up in the next hour. So you need to ask, will the pound dollar go up in the next 1 hour? With a time frame, that will sound more appropriate in a way. But even though it is more appropriate in terms of a question, it is like trying to predict the market. The job of the trader is actually react to the market. Because if you predict the market, I think pound dollar is going to go up, I will buy. But as the price is going down, what do? I will be thinking, oh, my prediction should be right, and I hold on to a losing position. So to share some personal experience, I don't really like to predict where the market will go. I will trade the market. Meaning to say, if it goes to certain price, I will buy. And if it goes to a certain price, I will sell. Expecting it to go down, I don't predict, but I will react accordingly. So if it really goes down, either I set a fixed take profit or I do a trailing stop. And I also don't predict how much it will go down. It can go down 300 pips, go down 500 pips, I don't care. I will just trail as much as possible. That is sharing my personal experience as a trader. I prefer to react to the market rather than predicting the market. So having said that, this is pound dollar. For upcoming week, there are quite a number of data that will affect the pound. It's short-term wise. So earlier on we have run through the calendar already. So one suggestion is to trade the news on pound dollar. But having said that, I'd like to highlight, if you have not been trading the news, maybe you can start off with a demo account and trade the news first, because there are some risks when trading the news I wish to highlight in terms of market volatility, possible slippage and gapping, because when there's major data or major events, market tends to be quiet, and once the data is released, it's like the entire market suddenly become active. So from a quiet market suddenly become a very active market in split seconds, because when the data is out, usually the whole world knows within a few seconds, given the technology nowadays. So within a few seconds, everyone start to react, and of course prices may start to go a bit haywire or high volatility. And when there's high volatility and fast movement, there lies opportunities, of course. But whenever there are opportunities, there are always risks. Whenever there's risks, there are opportunities. So as trader, do be aware of the potential risks. And one way to do that is to really watch the market during major news release. At least look at how the market move, how the spread behaves during major news release. So when you are eventually trading it with your real money, you are well aware of all the possible scenarios. You will not be caught off guard by the market. So back to pound dollar. As you can see, the chart is pretty much in a sideways fashion. There's no obvious direction, at least within the last few days over here, since middle of last week. Okay, from Tuesday onwards, you'll notice the sterling pretty much has, yes, gone higher in the first 2-3 days, but later half of the week starts to come down because of the dollar strength. And today, the start of the week, it bounced back up again. So that, just looking at the chart, it is telling us the direction of sterling is not very clear. So for this week, I do expect the data to play a part in sterling. That's number one. And number two, the testimony that Janet Yellen is going to give tomorrow and on Wednesday night, 11 p.m. will have an impact on the sterling, pound dollar, because it's a dollar base. So having said all this, I personally do not want to trade with any technicals, because with all these policy makers making their so-called statement, price will not respect the technicals very much. So they will react to what they have to say instead. So I'll put my comments here. So for this week, for this pair this week, I prefer to trade the UK data. The key reason, of course, when you trade the data is very short term. At the point, you can time your entry at the time of the data. You get in and out if there's a trade, and then usually you will get out within the first hour or the first 2 hours, even before Janet Yellen speaks at night. So you are already in and out of the market. So your position are not subjected to risk from all the speeches that she made. So that's my suggestion for pound dollar this week. Okay, let's look at another suggestion. Pound yen H4. So this is pound yen H4 chart. Not surprising to see this chart. There's no clear direction as well. Main reason it is quite similar to pound dollar. The dynamics between pound yen and pound dollar. It is UK, US, Japan. So UK is quite standard. The Brexit concern plus if it's good data. So this is the two driving force of UK. And US and Japan, it will be depending on their monetary policies. So Japan monetary policies, I think they are still like wait and see, even though Shinzo Abe and Trump has met last weekend, but nothing concrete. But what we have seen in the news, it seems that Trump is quite positive in terms of a personal relationship with Shinzo Abe. So he sort of backed Japan up 100% when it comes to the North Korea test firing kind of situation. But in terms of trade and currency wise, he did not really mention much. He leave it to his team to negotiate the rest. But on a personal note, at least he's not on bad terms with the Japan leader. So he's quite on a good term in a way. So Japan's side, we do expect them to maintain their monetary policy, waiting for actions from US instead. So I think they are smart enough to wait for US to do all the dirty work for them. So if by strengthening the US with the dollar strengthening, relatively the yen will remain weak. So it is good for Japan in terms for their exports and also for them to hit their inflation target. So having said all this, if Japan maintains status quo, no big change to their monetary policy, sterling is a common denominator for pound dollar and pound yen. And US dollar will be the driving force for of course pound dollar and dollar yen. So having said all this, the conclusion between pound dollar and pound yen, most likely in the near term they will have similar behavior. So you will be trading the UK news on sterling yen as well. So this is my comments, but I also know that if your finger is very itchy, you really want to trade this pair. Okay, here's what I'm going to do. If you use a gun and point it to my head and say win, I don't care, you must give me something for this pair. If that is the case, then I will use technical to give my way of trading. That means I put aside all the UK news, just purely looking at the chart. The price action, of course, the near-term price action is heading upwards, bullish, but sort of finding a pause over here. Okay, I'm going to put some levels and prices for your consideration. $14240, that will be the resistance that I'm seeing at the moment. Prices is squeezing itself towards 14240. No catalyst to push it higher. So the two suggestions over here, as usual, I'll draw my box for a long trade. So this is a long suggestion. I put a vertical line, time of the webinar. If the candle close into the blue box, okay, I need the blue box to be higher. Okay, at least higher than the last tail over there. Okay, somewhere in the blue box, that will be a blue box, close into the blue box or beyond the blue box, higher than the blue box is fine. That will be the signal for me to go long. That is an aggressive way of going long. If you prefer a more conservative way, then you wait for price to go up beyond the blue box. Oops. Then when price retrace back downwards and bounce back up again to where the blue box is, if it closes around the blue box or higher, that would be the conservative entry. Okay, the second, the green arrow, I'm going to change the arrow to a green color. The green arrow is basically the more conservative entry. So that's one. And of course, the risky trade, I would say, going against the momentum. Okay, it's an upward momentum. Some of you who like to trade a counter trend, for example, then this would be a suggestion over here at the blue box. If candle close below at the blue box or lower, that would be my signal to go short if I want to take a short trade. Okay, so this is my technical suggestion for pound yen. Again, I like to caution, technical trade, usually I don't take it around the news or data time. So if you look at the news calendar, you could go to fxstreet.com, you will see the calendar, and take note of all the UK news, especially the orange and the red flag ones. And usually new UK news is around afternoon time, GMT plus 8 time zone. Usually between 3 to 5 p.m. that kind of time. So during the time, I would not usually apply any technical trading on the sterling pairs. I may choose to switch to a news trading strategy for the sterling pairs instead. Okay, so the comments over here use a news trading strategy for this pair, or this is a technical suggestion out of the news trading window, which is typically plus minus 1 to 2 hours before and after the news or data release. Okay, when there's a question on my screen, how many pips am I going to take? Usually for last time I used to look at support resistance and tell me where to place my take profit. Nowadays I tend to leave my take profit open. So when I mention use support and resistance to tell me where to take profit. I will use this pound yen as an example to illustrate. Assuming if I, for this short trade example, okay, if price really close below and then give me an entry to go short, my first milestone, or rather first profit target, would be the box over here, the green box over here, because that's where before price is hit into the immediate support. So that's usually my first milestone where I decide whether to close partially or close off all the position. And for the long trade over here, if it fulfills the criteria for me to go long, then where is my target? For this trade, if I look at the chart over here, it doesn't give me any reference for the next resistance. That's basically, unless I start to scroll back the chart, I shall not go into that yet. But we make it simple. Just look at this chart. If there are no reference to any immediate resistance, as you can see, no candlestick. So what I'll do, I'll just leave my take profit open, part 1, and once the price move in my direction, about 90% of my stop loss. Example, if I place a stop loss of 50 pips for this long trade, 90% of 50 pips is 45 pips plus minus. So as long as the market move in my favor around 45 pips, 42, 44, 45, around there, I will decide whether to take partial profit, or minimum I will do is shift my stop loss to my entry price. That is the minimum I would do. Then I let the price go. Depends on how far I want to go. Of course, if the price doesn't have momentum to go any further and start to drop to hit my stop loss, then I'll get out. I mean, the stop loss would close my trade for me, and I don't make much, or most likely I will break even in that case. But at least I don't lose from the trade. So I don't have a fixed pips that I would take from the market. I'll let the market decide how much the market wants to give me. After all, the market is a 5 trillion market. My bank account doesn't have 5 trillion. So I leave it to the big boys to tell me how much they want to give me. Euro dollar 5 minute. If you talk about 5-minute chart, it would be most likely news trading for me. I don't really trade the 5-minute chart on a day-to-day basis. Whenever I go to a 1-minute chart or a 5-minute chart, it is usually when I'm trading the news. So let's look at, I'll use euro dollar as an example when I'm trading the news. Okay, let me find example. Okay, here is an example. Assuming the vertical line is the current time, whatever beyond the chart hasn't happened yet. Okay, if you want me to show you how I trade the 5-minute chart during news, I'm going to show you this way. Vertical line is the current time. And for discussion purpose, I'll put this as the news time, the next vertical line. News or data. release. Okay, the next vertical line over here is a data release, where the data release and go up. So usually before the news, market is pretty quiet. Chances is it's trading in a sideways fashion. So the vertical line is the news. Prior to the news, maybe 5 minutes or so. I'm going to make the candle bigger so that it's easier to see on your screen. Okay, current time. So as the current time moves towards the news time, 5 minutes before. So 5 minutes before the news, chances is this candle is moving or this candle is moving. Okay, these two candles over here. Okay, 10 minutes before the news. So 10 minutes before the news, I look at the price. It is moving in such a manner. If my trade is to put a pending long, anticipating a good news for euro. So the price at that moment is about 10621. Okay, plus minus. So the price at the moment is about 10621, 1.0621. So for euro dollar, I'll place a pending order about 12 pips above the current price. So 12 pips is about 33. 12. That's 12 pips. Okay. For me, you may see, wow, how come it is so far away from the current price? As trader, you must get used to the perspective. Don't be de-illusioned by the distance between this distance. It may seems like a very wide gap, but as a trader, you must accustom to pips. To look at it from a pips perspective, this is only 12 pips. It doesn't mean that even if the 12 pips is all the way up here, it is still 12 pips. Don't get this illusion by the chart saying, why it's so far away. So get used to it. Okay, when I say 12 pips, it's about here 33. So that's where I put my pending order to go long. And some of you, if you think that, oh, 12 pips away, I'm losing a lot if the market really move in my favor. The other thing I wish to highlight, when I trade the news, I'm trading in the direction for surprises. So in the direction of surprise means, for this example, market forecast a bad number for euro. That's why euro dollar supposed to drop if the actual number comes in as expected. So for me, when I trade the news, I will position myself in the event the news surprises the market. If the market expects bad result, I position myself if the actual is good result. So if the actual is good result, euro dollar should go up. So that is what I call the surprise trading. So in a surprise trading, if it really happens because it surprises the market, chances is price will move way more than 12 pips. So giving this much allowance is perfectly fine for surprise news trading. So that's where I put my pending order. Then I will watch the market. Okay, it doesn't mean, oh, 5-10 minutes before the news you put a pending order, then you can go and drink a coffee first, then come back and look at the chart. No, because within that 5-10 minutes before the news, you never know what will happen. Prices may start to creep out and trigger your pending order even before the data is released. As a trader, we definitely doesn't want it for that to happen. We want the data to be out first to make sure it fulfills our criteria, like what I have given earlier on. Then we know whether to keep our pending order there or to remove it as soon as possible. So if the price starts to creep up towards my pending order, I will definitely modify it to shift my pending order higher, so that it is about 10 to 12 pips above the current price. And of course, if the price starts to creep down even before the news is out, then I will adjust my pending order lower. So it's always trailing. The pending order is always, the entry price is always trailing the market by 10 to 12 pips. Of course, don't need to keep changing it. Oh, if the price move 1 pip down, you move your pending order 1 pip down. Doesn't need to. If it move a few pips down, then you move 1 time. If it move a few pips up, then you move 1 time. It doesn't mean every time the price tick 1 time, you change. So after for the 5-10 minutes, maybe you keep monitoring, and when the data is out, of course you have to check with FX Street calendar to look at the actual data. So once the actual data is out, in the scenario the criteria doesn't fulfill your criteria, then all you need to do is to delete your pending order. That's number 1. Number 2, if in the event market is volatile, it triggers your pending order before you can delete it, but the data criteria is not in your favor, then I would exit the trade regardless of how many pips I'm losing or how many pips I'm making. My reason is, if it doesn't fulfill my criteria to keep my trade, then I will always get out at the fastest possible time, regardless of whether it is making money or losing money. That's my guideline. Then of course the next one is, if it fulfills for you to keep a pending order, then you leave it there. And chances is the price will trigger your pending order, will move higher if it's really a surprise news. Then the next thing is to manage your position to get out. So how do I manage my position to get out? Assuming this is the case, my pending order is around this price, 1.0629 example. So the price at the time of news release, the price start to shoot up, fulfill the criteria, trigger my order. So after trigger my order, the price starts to hover in a sideways manner. This is a 5-minute chart. After the news, as you can see, it has more than 12 candles, meaning to say it is more than an hour plus minus. So my pending order is triggered, but the market failed to move higher or failed to move lower. It is basically hovering for 1 hour. This is a sign telling me that the market is not reacting to the news at all. So what do? Close the trade. So this news trading, typically my position will not be inside for too long, unless it is I'm trailing it. That means the market is moving in my favor. After I shift my stop loss, it is still moving in my favor, then I will keep trailing as long as it takes, until my trailing stop is being taken out and my position is closed. So that is how I trade the 5-minute chart during news. Okay. Hope you have taken down notes of whatever I said in the past, like 15 minutes. But if you have not, no worries. This webinar is recorded and uploaded to Fullerton Suite within 2 to 3 hours time. So you can review the webinar. You can pause it, play back as many times as possible. So this is how I will trade the 5-minute chart on news. Okay, for this week, we have not taken a lot of charts, but no worry, the market is always there. We will come back again next week to look for trading opportunities. But for this week, thank you for the question asking me how to trade the 5-minute chart on euro dollar. That is the first time I think I shared so much about my way of trading the news using the 5-minute chart. And I hope you all like it and find it useful. So time flies, especially when we enjoy the time. It moves faster than we have expected. So we have come to the end of the webinar. So on behalf of Fullerton Markets, I thank you everyone for your patience and your support for the webinar. And I hope that the webinar has been beneficiary to all of you. And I look forward to seeing all of you same time, same channel next Monday. And once again, wish everyone a happy Valentine's Day. This is Wayne, Head of Research and Education, signing off. Good night and bye-bye.